Good morning, welcome to the Market View for Friday the 6th of June 2014. And starting off with the 30-minute chart, we can see that we had a signal yesterday. There was no news out in the morning apart from the G7, which was in the background, of course, and obviously this only assisted with moving the market higher. Of course, the main news yesterday was around midday, and then at 12:45 the European central bank's decision on interest rates. You can see this reaction here, and then the market moving higher for the rest of the trading session. So yesterday the market managing to offer a trade with a maximum of 38 pips there on this particular trade, and of course the market moving back to the downside there after we get the red candle. So worst case, if you were trying to hold this position, which would have been unwise with the amount of news that I warned you about yesterday, the G7 and the interest rate decision, this is probably one of those days where it was best to have taken the profits out of the actual trade. So again, you can see the reaction there for yesterday and how the market reacted with the reduction in interest rates in Europe from 0.25 down to 0.15. So 0.1 taken off the rate for the Eurozone, which indicates, of course, there's likely to be some more QE money coming into Europe as well. On the daily chart, we can see the market trading back there. Let's just drag this over a bit, and we can see the market trading through the 76% that we marked up on the charts yesterday. It's just a bit of a clean up before we continue. We'll get rid of this one as well. And let's just mark up a few more to the upside. So from this high to this low, this is the next high to the left-hand side of the chart. This is the low. So we're looking at around 168.35, obviously just before the 168.50 area where the next resistance is likely to be in the market. We can see the market at the moment currently finding support at 168.09 there at the moment. So let's just remove this fib line now, and we'll just save the chart as well. So that's the upside. On the downside, we've got a low here to this high, and this is sort of the I will say the second lot, and the reason for that is if we go from this low to this high, you can see we have these figures as well. So these areas are likely to be support areas. Any of these prices here that you can see, make a note of them. These are areas where the market is likely to find support. However, I say that cautiously because today is a big day news-wise. We've got nothing from the UK of any significance, but at 1:30 we have the biggie of the week, which is the non-farm employment change, and this is out at 1:30. So watch the market at 1:30 today. They're expecting the figures to be worse than expected, but that doesn't mean to say that the market will act or react negatively to that. So again, keep this in mind. So 1:30, and then the unemployment rate at 1:30 as well, which is forecast to be 6.4. You can see that the forecast is slightly higher. So the US economy really not doing as well as the propaganda machine is putting out. And talking of American markets, I just wanted to show you the Dow. I have a chart, a monthly chart of the Dow. And this is it goes back to the day the Dow actually started. I mean, you can even see the 1987 crash there. But I just wanted to highlight something to you. We have what's known as a parabolic up move. The market is just rising. But if you look closely, you can see that the volume from 2009, when we had the first bout of QE, is actually falling. And if you look closely down here, you can see for the last 3 months, or certainly the last 2 months, the volume has started dropping off, and yet prices are moving higher. So stocks are basically levitating. And yesterday, of course, we saw the market move higher as well. I'll just convert this to a daily chart for you, and you will see that prices there up sharply for yesterday. The last correction we had in the market was back in February, And take note of this area here as well when we come back to this in just a moment. And we see yesterday the market moving higher by nearly 100 points, new highs, all-time highs, and it makes you wonder how much more this market can actually go without the correction, which is why it's important to keep an eye on the non-farm payroll figures today. There has been a trend recently. We saw this yesterday in the 10-minute chart with ETX, and also the 5-minute, where the market moved lower to begin with, and then it just reversed and off we went back to the upside, which seems to be the picture for this market for this week. If you look at it closely here, you can see that each day the markets open, move lower, and then always come back and finished on the highs, and that's been the picture for the last week. And we can see some buying here as well. So again, I wouldn't be at all surprised if we don't see newer highs or all-time highs as we go through the next few days until the market is ready to actually correct, whether that's some geopolitical event or whatever the event's going to be. There's got to be something that's going to stop this market in its move. It can't continue in this vertical climb. No market has ever been able to achieve this without having a major correction, which we've seen in 2011. We had one in 2010, but we've not had a decent one for some time. And there comes a point when a correction is going to happen. And if we have a look at the implied volatility, we can see that it's down slightly on the day before, but the historical volatility is coming back to these lows. Now, I mentioned February when we were looking at the daily chart of the Dow, and you can see here the big spike up in the implied, and if we go back, that's where the correction took place in February. In fact, I'll just put this back to a daily chart so you can see it a little more clearly. So you can see there we had a drop-off in the Dow during February, and if I can find the right tool in here, I will... oh, it's not in this version. I was going to measure the correction in points, so we'll do it manually. So the market broke there, 16,316 down to 15,356. So a 900 plus move in the correction in February. And again, you see this spike up in the implied volatility, which is rule 2. We see a 100% increase in the implied. That stops the down move. And then we see the market resume its normal course of moving back to the upside. A lot of resistance in these areas, but this has now been taken out. But again, like I said earlier, it all depends today really on the non-farm payroll figures. So keep an eye on those. Right, well, that's it from me this morning. It's Friday, of course, so wishing you a relaxing and peaceful weekend. And as ever, thank you for your support and also for watching.